Good day overall for the bulls. But when you look at right here, you look at the daily chart, and you see that the bulls got a decent entry bar following yesterday's high one. And that's good for the bulls. But the reality is, think about how the day formed. I'll talk about that in a second. But we have a trading range on the daily chart, and you can see that the odds favor the market going sideways. We're probably going to go above the August high. And that's reasonable to expect. Even if we get up to 6,600, I suspect at some point we're going to test all the way back down to this price level. So I think we're forming a trading range, and it could go sideways to up for several bars and then test down. But when we look back, this whole thing will probably be a trading range. Bears, they need more selling pressure than what they've got right now. 5-minute chart, what a strong bull trend. I say that jokingly. For most of the bars, it was hard to assess if the market was either in a bull trend, or if it was in a trading range. And that's pretty common. There we go. Had to move something. But anyways, it was really difficult for the most part. And it wasn't all that clear. You get a rally up to bar 2 and 3, pull back, and then you get a rally up to bar 10. And then the market goes sideways for more than 30 bars and has a relatively deep sell-off. You get a big sell-off, then a big reversal, sideways to up for several bars. You get a 1-bar breakout sideways, and then a sharp reversal down. And that's consistent with trends that are evolving into trading ranges. First bar of the day, we gapped down on the open and we formed a bull bar closing on its high. That's a strong enough bar, plus the rally up to yesterday's 81 is a strong enough breakout on a higher time frame that the odds are we're probably going to test the yesterday's close. We're probably going to rally up to 81. And then 2 consecutive bull bars. Good for the bulls. Strong enough breakout that the odds. Consecutive bull bars, good for the bulls. Strong enough 2-bar breakout. Probably the first reversal down will be minor. But you have to notice the low of 2 has a tail below the bar, and 2 has a tail above the bar. And that's a warning that the bulls are not as strong as they could be. 3, doji. We have 3 consecutive bull bars, but body's getting smaller, tail's getting more prominent. Increases the risk the market's going to pull back, and you can see the high of 3 is testing the low of 81. And that's a warning that the market is probably going to have, that's a warning that the market is approaching resistance. 4, big bear bar, good for the bulls, strong enough breakout that we may get a small second leg down. But when you see 3 consecutive bull bars and 4 being at support, that's a pretty dangerous sell and increases the chances of buyers below. 5, reversal up. The bears couldn't even trigger the sell on 4. Strong enough reversal. 5, odds are we're going to go at least a little bit higher and probably go above yesterday's 81 high and trigger the high one buy on the daily chart. 6, bear bar, inside bar. Bears who sold the close of 4, disappointed with 5. They're using 6 to buy back their shorts. And then 7, we broke above the doji on 6. But we closed as a doji bar on 7. And for the bears, that's a weak low 2 short, increasing the odds of buyers below. Not a good sell below the bar, and therefore bears may look to sell higher. 8, bull bar closing on its high. Good for the bulls, probably going to go at least a little bit higher. We're getting a breakout of the first 6 bars of the day. And at this point, there's typically at least a 50% chance we've seen either the low or the high of the day. And therefore, there's probably a 50% chance we've seen the low of bar 1. 9 consecutive bull bars, 8 and 9, probably going at least a little bit higher. 10, a strong bull bar, good for the bulls. But what do you notice? 10 is the biggest bull bar in the rally. And while 8 and 9 are good for the bulls, 8 is overlapped by 7. 9 is overlapping a decent portion of 8. And 10 has a small tail below the bar, but the body is climactic. It's bigger than 8 and 9. And that's a sign of a possible bi-vacuum test of resistance. Doji, 11. Not a great sell for the bears. Probably going to go at least a little bit higher, but a warning, we may go sideways around this price level fairly soon. We're approaching resistance, the high of last Friday, or the high of last week, which is last Friday's high, and that increases the chances that we're going to get there, but it also increases the risk that the market goes sideways at that price level. Bear bar, inside bar 12, probably buyers below, and then 13, second leg up. Good for the bulls, probably going at least a little bit higher. 14, bear bar, not a good sell, below. The bears have yet to make money below any bar today, and that increases the risk that we go more sideways to up. Consecutive bear bars, 14 and 15, good for the bears. We may get a small second leg down, but even if we do get a second leg, I suspect there's buyers below. And then 16, sold off, testing the moving average. And falling below the low of 13, falling below the low of bar 10. That's a warning that the market is in a trading range. Whenever the market's falling below strong trend bars, that's a sign that the market is in some form of a trading range. Trends don't typically do that. Reversal up, 17, good for the bulls, probably going to go above the high of 13. And then bear bar, 18, but not a good sell below the bar, probably buyers below. And then doji, 19. Bulls who bought above 17, disappointed 18, getting out break even, 19. And then 20, we have an outside up bar, good for the bulls, probably going to get an upside breakout. The trading range from 11 to 19 is probably more of a bull flag than the start of a bear reversal. 21, doji for the bears, and a failed breakout above 20, but not a good sell below, so probably buyers below. 22, consecutive bear bars, 21, 22, but overlap, and that lowers the probability for the bears. And then 23, bull bar, good for the bulls, probably going to go at least a little bit higher. 24, bear bar, closing on its low, good for the bears. The bears are doing a good job making the market go sideways, but let's see the bears get below the moving average. So far, the market's had 24 closes above the moving average today, and the market's had about 22 bars completely above the moving average for the entire day, and that's a sign that the bulls are in control. 25, doji, probably sellers above, and then 26, a bull bar. While 25 might have sellers above, the reality is it's selling at the moving average, and that's dangerous. Bears who sold the 25 high, they'll probably be quick to exit after they see 26, and therefore they may look to get out break even. And 27 sold off pretty sharply. That's good for the bears. They got a second leg down after 24 and 25. However, it's the first close. It's the first test of the moving average since bar 5, and therefore odds favor buyers. 27, what about selling it? I would not. We're probably going to get an upside breakout. The bears tried to get the breakout below the moving average and they failed. And therefore the bulls will probably get another leg up in a test of the high of last week. Bull bar 28, good for the bulls, probably going at least a little bit higher. And then 29, a bear bar. So the bulls and bears are alternating bull and bear bars. And that's a warning that the bears are not as bullish. That's a warning that that this small pullback rally is not as strong as it appears, and it's probably going to have a lot of trading range price action. Doji, 30. Looks like we're going to go mostly sideways here. We're really close to the high of last week, but the risk is getting big for the bulls. For the bulls, most recent higher low is the 27 low, and I don't know if the probability, let me say it differently. The market is far from the 27 low, and I don't know if the reward is high, I don't know if the probability is high enough for traders to buy the close of 30 and put a stop below 27. 1 times the risk takes you near 6,500. And we're probably going to pull back before we get there. Doji, 31, not a good buy. 32, another doji, a sign of waning momentum for the bulls. And then 33, a bear bar. Looks like I'm probably going to get a pullback here. 33, 34 consecutive bear bar is probably going to go at least a little bit lower and test the 27 close. But once you get near the 27 close, you're probably entering the buy zone, and that's an area where bulls will look to buy and bears will look to buy back their shorts. 35, strong bar for the bears. Climactic bar increases the risk that we pull back soon. And by pullback, I mean increase the risk that bears take partial profits. But some traders are not going to buy the close of 35 because 33, 34, and 35 are likely to at least get a second leg down. 36, bull reversal bar. Good for the bulls, a sign that bears are disappointed in scalping out of shorts. But the sell-off down to the 36 low is strong enough that the bears will likely get a second leg down. However, if the bears do get a second leg down, I suspect there's buyers below 36 and buyers below 37. And that's what happened with 38. 38, we broke below 37 and 36 and found buyers, and the market reversed up. Bulls were able to buy above 36 and buy more lower. And that's a warning that the market is likely in a trading range. 39, good for the bulls. 39, a bear bar, but not a strong bear bar. At support, probably buyers below, and a bounce and a test of the moving average and the 33 and 34 low, where the bulls started buying and scaling in. Surprise, 40, good for the bulls, probably going at least a little bit higher, but I suspect the follow-through is going to be disappointing and the market's going to go mostly sideways. The one thing the bulls have going for them is the high of last week, last Friday's high. It's a magnet, and it's a strong enough breakout bar on the daily chart that the market's probably going to go above it. So we're probably going to reach the blue line, but we have to get a pullback first. And then the bulls got followed through, 40, 41. That increased the probability that the first reversal down was going to be minor. Bear bar 42. Bears, they're hoping it's a lower high. But after the bull bars, 40 and 41, probably buyers below 42 and a second leg up. 43, bull bar. It's a high one buy, but after a surprise, 40, 41, probably going to get the second leg up, and therefore selling the high of 43 is probably not worth it. 44, follow through for the bulls. Good for the bulls, probably going at least a little bit higher and going to reach the blue line. 45, another bull bar. Looks like we're going higher, but body's getting smaller. Some bears will sell below 42 and sell more above 42, betting that the market will retest the 42 low or that they can get out break even on the entire trade. 45, testing near the low, but not quite there. A second entry for the bears, but after 40 and 41, selling below 46 is low probability. And then 47 went one tick below the entry price of the bears who sold below 42, allowing the bears out of their trade. Break even, plus if they scaled in. So if they sold below 42 and they sold more higher, 47 allowed them out of the trade. 48, doji, not a good sell below. The bulls see a trading range above the moving average after the breakout 40 and 41, and therefore they expect a second leg up and a test of the 30 high and the blue line, the high of last week. Not a good sell, 48, probably buyers below. 49, not a great breakout bar, closing below its midpoint, but still a bad sell below, and therefore increase the risk that we continue to go sideways to up. For the bears, they'll see a parabolic wedge, 42, 45, 49, but minor reversal lowers the probability of bears selling below it. 50, consecutive bull bars, 49, 50, right at the target, the high of last week, probably going to go above it. 51, doji, but not a great sell, probably buyers below. And then doji, 52, really tough to do anything here. And then bull bar, 53, good for the bulls, touching the blue line, probably going to go above it. And then we finally went above it on 54. One of the problems the bears have is that while the market is at resistance, the high of last week, we're forming a fairly tight bull channel ever since the 43 low, and that's a breakout on a higher time frame. And because of that, it lowers the probability of traders selling in this general area and increases the risk that the market is going, that whatever reversal down we get is going to be minor. Decent bear bar 55, good for the bears. We're probably going to go, well, we may go a little bit lower. I suspect there's buyers not far below, and therefore it's okay to exit shorts below 55. It's still a tight bull channel, and that makes it tough for the bears to be selling. But it's a bear bar closing on its low in mostly a trading range environment. I think there's nothing wrong with exiting. And then we got a doji 56, not a great buy above, and then we got the surprise bar 57. 57, good bar for the bulls, but context is really not ideal. It's a strong bull bar late in a rally at resistance, the all-time high, and therefore there's probably going to be more sellers up here. It's also a strong bull bar breaking out above the high of last week, which was last Friday's high, and then you can see it's that big bull bar on the daily chart in the center of the chart. Odds are bears selling the high of that blue line, high of last week, H of LW, that stands for high of last week. Odds are the bears selling above it are going to make money. When you see a bear bar for the follow through 58, I thought a lot of bulls were likely going to start selling out of longs, and bears would begin to build a position, betting that the rally above, betting that 57 is a buy climax and exhaustion for the bulls. Bull bar 59, good for the bulls, but a high one buy right below resistance. One second here. Anyways, high one buy 59, probably sellers above. 60, second entry sell with 58 and 60. Not a great sell below because the channel's tight, but from a context standpoint, it's a reasonable sell. 61 consecutive bear bars. The more we go sideways, the more traders are going to start selling out of longs, betting that 57 is a bull trap. Doji 62, and then we got another doji 63. This is really difficult to trade, and most traders are better off waiting. 64, we tried to break out of the consecutive inside bars, the triangle 62, 63, and we failed. And then we reversed down 65, 65, probably okay for a sell, betting on a test of the 57 low or 56 low. Always in bulls, probably going to get out below the bar. 60, 66. If I said 67, I meant 65 on the prior bar. 66 consecutive bear bars, probably going at least a little bit lower. 67, 3 consecutive bear bars at the moving average. 4 bar bear micro channel with all 4 bars closing below their midpoints. And we haven't had a close above the open since 59. Probably good enough for a second leg down. Then we got another bear bar, 68, right at the high of last week and the 57 low. Probably going to fall below the 57 low and the 56 low. And then we got the surprise, 69. 69, enough of a surprise. It's more of a profit maximizing bar than the start of a bear trend. And you can see I made the comment that 69 allowed the bears who sold the close of 35 out of their loss. Bears who sold the close of 35, theoretically, they got the second leg down later in the day on 69. 69 is a dangerous bar to sell because it's a very big bar, and I call it a high Z-score bar. Z-score is just a measurement. You can Google what it is, but Z-score, you just chat GPT it. It'll give you what the formula is. I don't have it on this computer, but I know basically Z-score is a measurement of the average bar size relative. It's a measurement of the average bar sizes, and it gives it a standard deviation. Z-score I don't have it on this chart, but anyways, I was just going to say Z-score That's probably a z-score of 3 or 4, which means it's 3 to 4 times away from a standard deviation. It's 3 or 4 standard deviations away from the mean, and therefore it's likely to pull back. Bull bar 70, good for the bulls. I want to look at something, just point something out. Something is happening, some sort of report. Kind of fun to watch. But you can see lots of trading range price action here. And look what happened in just a matter of seconds. Hopefully this computer doesn't blow up by doing a 30-second chart. This is a 15-second chart. This is a 15-second chart. And look what happened. So in 15 seconds, the market went up 9 points and then sold off 30 seconds later. You just want to see a 1-minute chart. Obviously, big selling. So in a simple, and I'm sure this is some sort of report that just happened. Someone said NVIDIA's earnings got released. I don't really care that it's NVIDIA's earnings. You look at the daily chart, you can see high one buy, but context is not ideal because of the trading range, on the daily chart. Anyways, thought that was just fun. Whenever you see this big, normally you don't get that kind of movement at the end of the day. And so when you see that movement, it started to rally up. I was watching as I was talking, and then when it started to go down real quick, I just wanted to point it out. It's not worth trading it. I think it's really easy to lose a lot of money on those reports. Bull bar 70, strong enough bar, probably going to go at least a little bit higher. And then 71, bad, low one, probably buyers below in a second leg. And then the market rallied into the close. And then the market went sideways. We finally reached, let's see, did it reach the all-time high? Price touched the all-time high to the tick. And then 5.5, 5, and then it went above the all-time high during this bar. But I made the comment, I thought the rally up to 75 was likely to go sideways. This is just too much selling pressure. So buying 74 or 75 is a dangerous environment. A lot of traders, if they're buying and they see a bar like 74, a lot of bulls will use it to take profits because it's not symmetrical. And if they don't use it to take profits, when they see a smaller doji bar, when they see a small follow-through bar compared to the breakout 75 or compared to the breakout 74, a lot of those traders would be quick to exit. And you can see the bears still got their second leg down. For stop entries, you can buy above 1, you can buy above 2. 80% of the time, you get at least some kind of minor reversal in the open. And therefore, you can wait for a pullback. You can buy above 5. And I thought it was always in long on 8 and 9. So you can buy above. You can even buy above 10. Better if you can use a wide stop scale in. And then where can the bears sell? I think all of these sells are minor reversals. Even selling 33 or 34 is probably minor. For the bulls, I think it's really hard to justify being long below 22, 24, and especially 29, 30. And even though the market's in a tight channel, it's really challenging because the reward potential is small and the risk is getting big. And at some point, you expect this channel to evolve into a trading range and test down to the 27 low or the 16 low, which it obviously did during 34 and 35. Bears, they can sell 34, they can sell 35. But if you're selling 35, you have to understand what you're selling. You're selling a bear breakout in what is likely to evolve into a trading range. And you got to be really quick to make decisions. And when you see 36, that's a warning that something is not right. And a lot of traders are going to buy back shorts somewhere in here. And bulls will buy as the market reverses up. 40, bulls can buy, betting on a second leg. And then some bulls get out below 42. If they do, they buy again above 43 or the follow through on 44. And then where do they get out? I think it's okay. It's easy to look at 55 and say, yeah, 55 is part of a tight bull channel. I'm not going to get out of longs, but I think 55 is a pretty reasonable place for traders to exit. So if you get out below 55, do you buy again above 56? I would not. I think the math is getting fairly difficult in here. And then bulls, would they buy 57? I think it's too big of a bar late in a rally. And if you do buy above 57, you probably get out break even somewhere in here. And then bears, I thought the bears, they could sell below 65. Bulls definitely get out of longs below 65. They can sell below 66, 67, 68. And then they probably take profits during 69. Otherwise, they get out above 70. And then bulls, they can buy 70. And that's pretty much it for the rest of the day. For stop orders, I thought it was an okay to buy below 3, buy the close of 4. And then I thought probably buyers below the 10 low during 16 and buyers at the moving average on 27 below 25. That's probably reasonable. Sellers above 31, but bars really small. I think that's just a tough trade in general. And then I thought an easy trade was buying below 37, low 1 short, probably buyers below. You can buy below 39. That's another reasonable trade. And then all through here, buyers below 51, but these bars are so small, it makes it tough. And then 63, probably sellers above, but tough to do. But logically makes sense, especially after 57. And then that's probably it for limit orders. Sellers above 76, but really too late in the day. Very difficult to trade. You look at this. And you look at this chart, it's just so easy to get chewed up. This bar alone is pretty big. It's almost 50 points. And the average bar size, the difference, 50 points, the challenge with what you have to remember is 50 points is obviously a large bar. But the problem is whenever you're trading in this environment, this range is smaller than what it's been over the past several months. And therefore, you're going to be positioned for a much smaller volatility than this bar. And so what happens to traders all the time, they increase their position because the bars aren't as big as what they used to be. And then all of a sudden you get this really big bar. And that is just a really bad mistake. I think most traders have no business trading report bars. Even FOMC. FOMC, it's fun to trade it. There's plenty of good trades during the FOMC. But the reality is FOMC is low probability trading. And what I mean by that is because FOMC is a report environment, there's greater volatility. And because of that, it lowers the probabilities it lowers high probability trades and increases lower probability trades. So whatever seems like a 70% probability is a lot closer to 65. And whatever seems like a 40% probability is a lot closer to 45. Another thing that traders make mistakes on is they'll trade reports and they'll just trade too large and not realize how large their position is until it's too late. Buy the close, sell the close. Probably okay to buy the close of 2, especially if you're willing to scale in. I thought buy the close 9, buy the close 10, especially if you're willing to scale in. And then 35, is it sell the close? Maybe, but you're selling really low in the range. So it's really arguably, it might be sell the close, but it's going to really quickly, if it's going to fail, it could quickly reverse. And you have to understand the logic there. Probably buy the close 41, especially if you can scale in, or just scale in instead of buying the close. And then maybe sell the close 66, 67, 68. Tough to do. And then, as far as buy the close, maybe buy the close somewhere in here for a scalp. But again, not that easy. Let me take a look at questions. Okay, question. This is at 12:57. I think you're talking about this area here. I think they're asking about the question here, but asking it during this time. Okay, question. I see that many bull channels, once they enter a trading range phase, there's an impulsive 50% pullback, and then the market continues straight away. What's the reason behind this? Yes, I think what you're asking is the market is in a bull channel and you get a sell-off to here. And if you do the math, sell-off is basically a 50% pullback. The market sells off impulsively and then reverses up quickly. What's the logic behind this? Yeah, a couple thoughts. One is risk reward. The risk becomes big for the bulls up here. Stop is far away and they take profits. And then once the market sells off, the risk gets big for the bears and they take profits, and the risk decreases for the bulls and they start buying. A more simple way to think about it is that this rally here is this on a higher time frame, and therefore the sell-off on 36 is 1130, and you can see it's this bar right here. We've had a series of bull bars in a row, and we have one outside bar here. Not many traders are going to sell below that bar because the channel up is too tight. And this sell-off, even though it's bear breakouts on a 5-minute chart, it's just a tail below bars on a higher time frame. Same thing over here. As strong as 69 was, all it's doing is creating a large trend bar on the 60-minute chart. And that's why those have a higher tendency of reversing up. So it looks like that is it for questions so far. As far as tomorrow, we have follow-through buying on the daily chart, but I suspect something probably is going to be disappointing. We've gone above the August high. I suspect the bulls are probably going to be disappointed within the next few days. I'll wrap it up with this question. So it's kind of a vague one, but someone asked, how do you know what the next bar is likely to do? During your end of day review, you predict what is happening. Well, I'm not predicting what is happening. I'm applying a probability to what is happening. And if you want to listen to that real time, you just go back on the recording, because obviously from somewhere over here to the end of the day, I talked about the bars as they were forming. End of day is always going to have, there's always an end of day, end of day is always going to have some bias, because obviously this is a static chart and I remember to a degree what the chart did. So there's always going to be a little bit of bias there. However, I'm thinking about the chart in probabilities. You always hear me say bulls and bears. And the reason, it frustrates people, but the reason you have to think about the market in terms of bulls and bears is you have to assign a probability. For me to understand the likelihood of the bulls succeeding, I've got to understand the likelihood of the bears succeeding. And if I only think about the bull argument, I can't define what the probability is for the bulls, because I'm not defining what the probability is for the bears. So a lot of times when I'm looking at a chart and I'm trying to figure out what to do, if the market's going up and I can't decide what to do, I always ask myself, what should I do? What would the bears do right here? And when I look at these bars, I think, bears aren't making money below bars. That's a problem. But the market is drifting up. Eventually, the bears are going to make money. Now, as far as, how do you know what the market's going to do next? Well, it's just experience. You start looking at a lot of charts and you start seeing a lot of these situations. I've seen a lot of small pullback trend from the opens that rally, go sideways around the moving average, and then they pull back. And then eventually, I started to realize through time that one of the reasons small pullback trends last all day is higher time frame context. This is not great higher time frame context on the daily chart for the bulls. And because of that, I thought this rally here, even though it looks decent, there's a lot of overlap here, and there's resistance above the high of last week, which was this big bull bar right here. And that made me think that if we do, we're probably going to go above it, but we're probably going to go far above it. And then when we had this big sell-off to 35, I thought to myself, bull trends that last all day, that are really strong, they don't do that. Small pullback trends, they don't force traders out of the trade. And they especially don't allow bears to make money with stop orders. But overall, the more you look at charts and the more you just have experience, you start to realize things that the market does. And a lot of times that experience comes from being on the wrong side of the trade. I wish I had a better way to answer your question. That's really the way I see it. The amount of times I've bought bar 1 and held all the way to here and then reversed down here and gave up everything I made. Or the amount of times I sold 35 thinking it's the start of a bear trend, refusing to get out and then getting trapped on this rally. The amount of times I've bought a bar like 57 thinking and hoping that the bull trend is going to continue, only to watch the market go sideways and reverse. I've done all those trades so many times. And therefore, it gives the experience there, helps me gauge what the probability is. I hope that answers your question. Is today a small retracement bullish day? Well, so someone's asking, Andrew's asking, is today a small replacement bullish trend day? For me, I don't really consider this a small pullback bull trend day. I think of it more as a trending trading range day or kind of a broad channel day. You can argue it's more of a trending trading range day. The reason I say that is once the market breaks out for 2 or 3 or 4 bars, it goes sideways for 15, 20 bars. You get a bear breakout, it goes sideways, bull breakout, sideways. So if we take away, if we just take away these 3 bars, 8, 9, and 10, these 3 bars, 33, 34, 35, these 2 bars, 40 and 41, it's lots of overlap. So I consider this more of a broad channel with lots of tight channels in between. And that's because the higher time frame chart is a tight bull channel. What do I think ultimately? I think this breakout is strong enough that we're probably going to pull back, form a higher low, and go at least a little bit higher. But if the bears manage to make the market go sideways for several bars, maybe it'll form a double top and we reverse back down to this area down here. All right, thanks everyone for listening, and I hope everyone has a great rest of their day. Actually, I want to see something before I end it, because we were talking about NVIDIA. Very climactic. And that makes me think ultimately, obviously this is it's a strong breakout on like a yearly chart, but I think NVIDIA is probably going to have to pull back. That is a very climactic. It's getting climactic. And therefore, we have a lot of trading range price action here. Makes me think that we're probably going to test breakout points at some point, but we'll see. All right. Hope everyone has a good rest of their day.